On July 30th, 2026, Reddit did exactly what a publicly traded company is supposed to do. They stepped up to the earnings microphone and delivered an absolute masterclass of a quarter. I mean, they didn't just beat analyst expectations, they completely obliterated them. Revenue was way up, margins were expanding, and free cash flow was literally pouring in. By every traditional metric, it was a flawless print. So, what happened next? The stock inexplicably cratered, dropping 12.5% in a brutal after-hour sell-off. Okay, we've got to dive into this because this massive valuation disconnect is the exact mystery we're unraveling in today's explainer. You look at the reality of the business right now, and it is a stark contradiction to how the market reacted. Q2 total revenue surged 61% year over year to $805 million. That comfortably beat Wall Street's expectation of $731 million. It's a massive 10% beat on the top line. Net income surged 183%. They generated $250 million in free cash flow. Yet, the market aggressively punished the stock, dragging the price all the way down near $155.80. Look, when a company crushes its earnings but the market sells off the stock, investors aren't looking at the last 90 days of performance. They are terrified of a hidden risk lurking just under the surface. Today, we're exposing exactly what Wall Street is so afraid of. But to really understand the threat, we first have to understand the machine that is actually under attack. Section 1. Reddit's Economic Engine. Unpacking a massive turnaround. If you look past the headlines, Reddit operates a highly differentiated, community-driven social platform. We're talking about more than 100,000 active, topic-specific forums, or subreddits, housing over 26 billion posts and comments. What's really fascinating here is how it positions Reddit right at the intersection of traditional social media and search. Think about it. When someone is on Meta or TikTok, they're just passively scrolling for entertainment, right? But when someone is on Reddit, they are actively researching, asking specific questions, seeking peer recommendations. That is a highly intent-driven environment, and it is incredibly valuable to advertisers. And while AI data licensing gets all the flashy headlines in the financial press right now, nearly 95% of Reddit's money still comes from its digital advertising machine. Advertising brought in $762 million in Q2, growing 64% year over year. Data licensing, that falls under their other revenue segment and was just $43 million. So here's the crucial takeaway. Reddit is not primarily an AI company today. They are a high-intent digital performance advertising platform. They're deploying new tools like dynamic product ads and an automated AI-driven campaign suite called Reddit Max to capture budgets from smaller, unmanaged advertisers. Basically, they are converting historically under-monetized conversational text into a high-yielding, conversion-driven asset. Let's break down where this money is actually coming from to build out the growth thesis. The United States is obviously their absolute powerhouse, generating $638.1 million and growing at an impressive 56%. But you really need to look at international revenue. It hit $166.8 million, growing at an incredible 84% year over year. This is massive evidence that Reddit is rapidly capturing performance ad budgets on a global scale. In the broader digital ad ecosystem, they were competing directly against the likes of Pinterest and Snapchat for those high-intent budgets. And these numbers suggest Reddit is gaining serious ground. Their global average revenue per user grew 36% to $6.18. Now sure, that's significantly lower than Meta's domestic averages, but investors really shouldn't view that as a weakness. That monetization gap actually represents a massive multi-year runway for market share capture. And here is the absolute secret sauce that makes all this growth so incredibly lucrative. 91.3%. That is Reddit's gross margin. Because their platform runs largely on the unpaid labor of volunteer moderators who curate the content, Reddit has an exceptionally low operating cost structure relative to the immense volume of content it hosts. Honestly, this is a software-like margin profile. When your operating expenses are largely fixed, a substantial portion of every new incremental advertising dollar flows straight to the bottom line. This operating leverage is exactly how Reddit managed to generate a staggering $261 million in free cash flow in just a single quarter, with capital expenditures limited to just $1 million. They are a phenomenally cash-rich, asset-light machine. Section 2, the AI search threat, the hidden risks spooking Wall Street. Okay, so if the fundamental business is this cash-rich, growing this fast, and producing these kinds of margins, what exactly terrified the market into a double-digit sell-off? Why hit the panic button on a company that just reported an 8th consecutive quarter of year-over-year revenue growth above 60%? Well, it all comes down to a single sentence from the earnings call. I want to read this exact critical quote from Reddit management. Search referrals were choppy and traffic was more volatile late in the second quarter. Those exact words are what triggered the drop. Investors immediately interpreted this commentary as an early warning sign that something fundamental in Reddit's user acquisition pipeline is beginning to crack. And that brings us directly to the existential threat of Google's AI overviews and this whole concept of zero-click search. See, Reddit has a structural dependency on external search engines, specifically Google, for its top-of-funnel organic traffic. Users Google a question, Reddit has the answer, the user clicks the link, and boom, Reddit serves them an ad. But what happens when an AI search engine just reads Reddit's proprietary conversations and simply summarizes the answer right there on the Google results page? The user gets what they need, but they never actually click the link. They never visit Reddit. The ad impressions vanish. This is the zero-click behavior that threatens to permanently cannibalize Reddit's organic traffic pipelines. Which introduces a very precarious secondary tension, the $60 million question. Reddit currently has an annual data licensing deal with Google, allowing Google to train its AI models on Reddit's 2 decades of authentic human dialogue. But with the upcoming renewal of this contract, there's significant negotiation friction. In fact, there is a very real, dangerous rumor that Reddit might block Google's web crawler altogether if negotiations fail. If that relationship breaks down, Reddit risks losing its high-margin data licensing fees while simultaneously harming its organic search traffic referrals. It is a massive game of high-stakes digital chicken. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. Section 3. Evaluating business quality. Beyond the headlines. Let's take a step back and objectively look at the company's overall quality amidst all this AI panic to see if this search volatility is a terminal warning sign or simply a temporary speed bump creating a massive buying opportunity. Synthesizing Reddit's qualitative scorecard gives us a very strong blended score of 8.1 out of 10. On one hand, their financial health is a perfect 10 out of 10. The balance sheet is immaculate, $2.8 billion in cash, 0 debt, and a $500 million undrawn credit facility. Profitability is a solid 9 out of 10, boasting a 31.4% GAAP net margin. But look at business viability, sitting at a 7 out of 10. While their competitive moat of asymmetric network effects is highly durable, that structural risk from search engine algorithm updates and zero-click AI answers is a heavy anchor on their long-term viability score. It is a fascinating battle between an elite balance sheet and an evolving traffic bottleneck. Before we look at the exact share price scenarios, I want to mention that all of the research behind this video was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles. Long-term compounders, quality businesses built to compound for years. Hidden gems, under-the-radar names with asymmetric upside. And dividend hunters, durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself. Or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Section 4. 5-year scenario analysis, a framework for future valuation. First, I need to explicitly state that this is a hypothetical framework for thinking about possible outcomes starting from a $16.80 share price. It is not a prediction, and it is absolutely not financial advice. The stock could go much higher or much lower than any of these scenarios. So, let's walk through the operational assumptions here. In our 60% probability base case, Reddit successfully navigates its search challenges and continues to gain ad market share. Over 5 years, revenue hits $9.6 billion, free cash flow margins settle at 36%, and applying a standard 25x multiple yields an implied share price of $394.23. But look at the high or bull case with a 20% probability. This assumes massive scaling in dynamic ads and a tripling of licensing revenue. Revenue hits $13.1 billion. Margins expand to a staggering 42%, and because they are viewed as a dominant AI enabler, they command a premium 35x multiple, pushing the share price to $911.29. Conversely, the 20% probability bear case models the devastating impact if AI search permanently cannibalizes organic traffic and licensing talks completely fail. Revenue growth slows drastically to just $5.7 billion. Margins compress to 25% due to rising user acquisition costs. And the multiple drops to 15x, in line with a slowing utility platform. This drags the share price all the way down to $94.01. Now, if you want to dive into the full math and detailed assumptions behind these targets, you can check out the full, free research report on Flash. Section 5, the risk analysis. What could break the thesis? So what actually pushes us into that bear scenario? What are the operational landmines that could break the long-term thesis? Well, one of the biggest is hiding in plain sight. $880 million. See, Reddit maintains its asset-light structure by outsourcing its hosting infrastructure, specifically through a massive, inflexible AWS cloud commitment extending all the way through June 2029. Now, while Reddit's balance sheet is pristine today, this $880 million contract represents a severe fixed cost burden. If organic traffic slows down due to Google's AI summaries and digital advertising revenue suddenly decelerates, these fixed cloud costs don't just go away. They will rapidly eat into profitability and severely compress Reddit's cash flow margins. So, what exactly should you be watching for? Here are the early warning signs investors need to monitor over the coming quarters. First, watch for sequential drops in U.S. daily active uniques. In Q1 2026, US DAU was 53.5 million. In Q2, it slipped just slightly to 53.2 million. If that trend accelerates, that's a major red flag. Second, keep an eye on ad pricing. If overall ad pricing growth falls below that 20% threshold, it strongly suggests they are losing their performance momentum against competitors. And finally, watch the headlines for any breakdown in the Google API negotiations. If Reddit resorts to a defensive crawl block, cutting off both high-margin licensing fees and organic user traffic, the bear thesis is officially in motion. Section 6. The bottom line. Resolving the Reddit disconnect. Let's bring this whole narrative together. We started with a massive disconnect. A company posting record 61% revenue growth, huge cash flows, and raised guidance, yet suffering a 12.5% stock drop. The bottom line is this. Wall Street isn't debating Reddit's current momentum. What they're debating is Reddit's future survival in an AI-dominated web. The pristine financials of today are violently colliding with the existential search risks of tomorrow. As Reddit CEO Steve Huffman noted, they are intentionally trying to build a daily destination. Ultimately, Reddit's survival comes down to one single test. Can they successfully convert drive-by anonymous Google searchers into logged-in, highly monetizable daily users? If they can, the AI search threat neutralizes and the business thrives. If they can't, they remain entirely at the mercy of the algorithm. If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.